So if you watched part 1 earlier this week, you know we dug into the April jobs report, Stellantis layoffs, and the false comfort in the Bank of Canada's claim that the system is resilient. But this is where it gets personal, because the cracks that we talked about last time, they're not abstract, they're not theoretical, they're happening in your driveway, in your mortgage renewal notice, in the quiet moment after the bills are paid or not paid. Let's start with car repossessions. If you want a real pulse check on how Canadians are actually doing, don't look at GDP or CPI. Watch the repo trucks. People will give up a lot before they give up the keys to their car. They'll delay groceries, sell furniture, skip the dentist, but they'll fight to the bitter end to keep their car because their car isn't a luxury. It means survival. It means getting to work, getting the kids to school, getting through life. And right now, Canadians are losing that fight. Car repos are up 23% year over year. We've blown past the pre-pandemic levels. RBC, one of the big five, for those of you who are watching from America, just reported a 54% jump in provisions for credit losses. So that means how much money they're putting aside to cover their own losses. And they know that it is going to go up. Equifax is reporting non-bank auto loans have gone up 12% in the last year. That means that people can't get at the dealer financing and cannot get financing for their cars at their banks because their credit health is falling so low. Household debt in Canada is currently at $2.57 trillion. Now, these aren't just numbers. These are real people falling behind and silently. And while the headline spins stories about Canadians not traveling to America like it's some patriotic resistance, it probably has a lot more to do with the fact that people simply can't afford the gas, the hotel, the flights to travel there. Now, let's talk about mortgages. Back in 2020, a lot of buyers were stress tested, which means that whatever their renewal rate or their purchase rate was, 2 percentage points were tacked onto it to see if they could afford their mortgage if rates went up higher. And it worked, sort of. And this year we're going to find out that it didn't. Because the real risk today isn't just the interest rate. It's whether the bank wants to touch the loan person at all. They don't want these mortgages anymore. If you're holding an uninsured mortgage, which means you don't have CMHC insurance on your mortgage, which means that you have more than 20% equity in your home. So you are a move-up buyer or you're in your third renewal, what have you. You have become toxic to traditional lenders. Early 2024, OSFI introduced new rules limiting how many of those high debt loans banks could issue, capping the mortgage amounts at 4.5 times annual income. And the banks can only hold 15% of their total mortgages in unsecured mortgages. Banks haven't cared much. They started pulling up back well before 2023. It was almost as if OSFI put the rule in place to justify what the banks had already been doing. True North Mortgage put it plainly. Banks have no appetite for refinance risk anymore. If your debt to income is too high or your home value has dropped, you're out. And to those people who bought houses in 2020, 2020 was at peak. Now values are down 25 to 30% in most areas. So that renewal offer, it's based on an inflated balance. Those people are all underwater and the banks know it. That's not a refinance. That's financial dead end. When those people cannot find their refis, are they going to choose to go with private lenders and pay 12, 14%? Or are they going to put their house on the market, a market where people already aren't buying? Now, about that, March, and these are GTA home sales, new home sales in March of this year, 385 units. That's 68% drop from last year and 87% below the 10-year average. Condo sales down even further. Single family homes down 61%. In April, the Toronto Real Estate Board reported 5,600 sales. That's 23% drop year over year. And listings are climbing. Inventory is building. But the average sale price is down more than 4%. So where are these people going to go? What are these people going to do if they can't refi in the next 18 months? The market is stalling, and it's happening at the exact same time that 60% of all Canadian mortgages are coming up for renewal. This is a recipe for disaster. The banks see the car repos. They see the rise in defaults. They see the OSFI caps and the credit scores in decline. And they're not in the business of losing money. So they're tightening it quietly across the board. And that's where this gets really dangerous, because people aren't just stretched thin. They're cracking. Repossessions isn't a warning. It's a consequence. And mortgage denials aren't the start of the problem. They're the point of no return. So we can keep pretending this is a soft landing, or we can be honest. We're in free fall, and no one's reaching out to catch the people who need the help the most. We're being told elbows up, and that Canada is going to hold strong in the face of trade aggression. But while the headlines cheer on reciprocal tariffs, the families on the ground are being squeezed by higher prices, tighter credit, and a system that only protects the top of the top. If you felt any of this, if it's happening to you or someone you know, comment below. And if you're just waking up to it, maybe subscribe, because this isn't the end of this. And this isn't fear-mongering. It's already here. I'm sure I'll be talking about this more in coming videos. Have a wonderful day.